February 28, 2026, weekend, markets closed. And somewhere in the Middle East, hundreds of targets were struck in coordinated operations. The details are still emerging. The extent is still unclear. But one thing is certain. When markets open Monday morning, they won't open where they closed Friday. And I keep asking myself one question. If you're holding gold at $5,250 or silver at $94 and the market gaps 6% higher at the open, do you sell into the spike? Or do you hold because this is just the beginning? My theory is this. Weekend events create the largest information asymmetry in modern markets. The people who understand how gaps work, how dark markets price risk, and how Monday openings behave after geopolitical shocks, they position correctly. Everyone else gets trapped by emotion. Let me show you the pattern. Because we've seen weekend strikes before, and every time the same sequence unfolds. I'm not a financial advisor. This isn't financial advice. This is pattern analysis based on historical weekend geopolitical events, dark market pricing mechanisms, and gap behavior in precious metals markets. And what I'm seeing suggests Monday's opening could be one of the most volatile in years. But volatility isn't the same as opportunity. Let me explain why. Let me give you the framework first. Weekend strikes create a specific pattern in markets. 4 stages. Stage 1 is information blackout. Markets are closed. News breaks. But there's no price discovery mechanism. Equity markets, futures markets, options markets, all closed. The information exists. The impact is real. But there's no official price reflecting it. This creates massive uncertainty. And uncertainty is the most expensive emotion in markets. Stage 2 is dark market positioning. While official markets are closed, unofficial markets aren't. Physical precious metals dealers in Asia, Middle East, and parts of Europe are open Sunday. They're pricing metals based on what they know, and what they charge tells you what informed buyers are willing to pay. If a dealer in Dubai is selling gold at 6% premium over Friday's close, that's the dark market price. That's real information, and it predicts Monday's opening gap. Stage 3 is the gap open. Markets reopen. The first trade happens not at Friday's close, but at a price that reflects everything that happened over the weekend. If gold closed Friday at $5,250 and dark markets were pricing it at $5,560, the Monday open will be near $5,560. That's a 6% gap. Instant. No gradual move, just gap. And here's the critical part. That gap doesn't mean buy. It means the information is now priced. What happens next depends on whether new information emerges. Stage 4 is gap behavior. Gaps can fill or extend. If the weekend event is contained, if no new escalation occurs, if diplomatic signals emerge, the gap often fills partially. Gold might gap to $5,560, trade down to $5,400 by midday, and close at $5,450. The gap filled 50%. That's profit taking. But if new information emerges, if escalation continues, if oil spikes, the gap extends. Gold opens at $5,560, trades to $5,650 by afternoon. That's continuation. And continuation gaps are the dangerous ones because they signal the event isn't over. Now let me show you what we know right now. Reports indicate coordinated strikes occurred February 28th. Multiple targets. The scale suggests this wasn't limited action, it was comprehensive. And here's what matters for markets. Comprehensive operations don't end in one night. They either achieve objectives quickly, leading to containment, or they trigger responses, leading to escalation. We won't know which until we see how the next 48 to 72 hours develop. According to available information, there's uncertainty about key leadership status. Residences were targeted. but confirmed outcomes aren't clear yet. And this is where market psychology gets complicated. Uncertainty about leadership creates two possibilities. If leadership is confirmed safe and functional, markets might interpret that as operation didn't achieve maximum effect, conflict could continue. Bearish for equities, bullish for safe havens. If leadership status remains unclear, markets might interpret that as maximum effect achieved, regime change possible, conflict could end quickly. Bullish for equities, bearish for safe havens. Same information, opposite market reactions. And we won't know which interpretation is correct until more facts emerge. Now let me show you the dark market data. This is critical for understanding Monday's gap. Physical gold dealers operating Sunday in Asian and Middle Eastern markets are reportedly pricing gold at approximately 5.5% to 6.5% premium over Friday's New York close. That suggests a Monday open around $5,550 to $5,600. Silver, with its higher volatility, could gap proportionally more. If the gold-silver ratio holds at 56-1 and gold opens at $5,560, silver should open near $99.30. That's knocking on $100. But here's the key question. Is that the high? Or is that the launch point? Let me show you historical weekend strike patterns, because this has happened before. Example 1. Desert Fox, December 1998. US and UK struck Iraq over a weekend. Markets opened Monday with equities down, gold up moderately. But within days, the operation concluded, markets reversed, and safe haven premiums faded. The lesson? If operations are short and decisive, gaps fill quickly. Example 2. Assassination of Soleimani, January 2020. Strike occurred on a Friday. Markets opened Sunday evening, futures, with gold gapping from $1,520 to $1,588. That's a 4.5% gap. Then it extended to $1,613 within days. Why? Because Iran signaled retaliation. The gap didn't fill, it extended. And gold didn't peak until Iran's response occurred. The lesson? Gaps extend when retaliation is expected. Example 3. Abbottabad Operation, May 2011. Bin Laden raid occurred on a Sunday. Markets opened Monday with muted reaction because the operation was concluded, successful, and didn't trigger broader conflict. Gold barely moved. The lesson? Concluded operations don't create sustained gaps. So which pattern are we in? That's the billion-dollar question. If this weekend's operations are concluded, if objectives were achieved, if no retaliation is expected, we're in example 3. Gap opens, fills, markets normalize. But if operations are ongoing, if retaliation is likely, if this escalates, we're in example 2. Gap opens, extends, volatility continues. Now let me address the military demand angle for silver. Reports mention that certain weapon systems use silver. Tomahawk missiles, for example. Claims range from 5 to 15 ounces per unit, though higher numbers are mentioned without clear verification. Here's the math. If operations involved hundreds of missiles and each uses 10 ounces of silver, that's thousands of ounces consumed. If restocking occurs, and if broader conflict seems likely, military procurement could add incremental demand. But let's be realistic. Even 10,000 ounces is trivial in a global market that trades millions of ounces daily. The military demand narrative is interesting, but not a primary driver. The real driver is safe haven psychology and oil market disruption. Let me show you the oil connection, because this is the mechanism that matters most. Middle East supplies approximately 30% of global crude oil. If operations threaten production facilities, or if retaliation targets energy infrastructure, oil spikes. And oil spiking feeds directly into inflation fears. If oil goes from $88 to $110, that's 25% increase. That flows through to gasoline, diesel, jet fuel, plastics, chemicals, everything. CPI would spike within weeks. Central banks couldn't cut rates in that environment. And precious metals benefit because they're inflation hedges. So watching oil Monday morning is more important than watching gold. Oil tells you if this is contained or escalating. Now let me walk through Monday's opening scenarios. Scenario A, containment signal. Over the weekend, diplomatic channels convey that operations achieved objectives. No immediate retaliation expected. Oil infrastructure wasn't targeted. Leadership signals willingness to negotiate. Markets open with gap, but profit-taking dominates. Gold opens $5,560, trades down to $5,400 by midday. Silver opens $99, falls to $93. Equities recover from initial drop. By Tuesday, the event is fading from headlines. This is the gap fill scenario. Scenario B, escalation signal. Retaliation is announced or expected. Oil facilities are threatened. Regional allies mobilize. Uncertainty about leadership creates power vacuum fears. Markets open with gap that extends. Gold opens $5,560, trades to $5,700 by afternoon. Silver breaks $100, tests $105. Oil jumps to $105. Equities fall 5% to 7%. Volatility remains extreme for days. This is the gap extension scenario, which occurs. We won't know until markets open and react to overnight news flow. But here's the positioning framework for both. If you're holding precious metals going into Monday, here's the decision tree. Gold gaps to $5,560 at open. First hour, watch for direction. If it trades below $5,540 within the first hour, that's profit-taking starting. Consider taking partial profits on 30% to 50% of position. Keep the rest in case escalation continues. If it trades above $5,580 within the first hour, that's extension. Hold full position and raise stops to $5,500. Let it run, but protect against reversal. For silver, same logic. Opens near $100. If it trades below $98 in the first hour, profit-taking is dominant. Consider reducing exposure. If it trades above $102, it's extending. Hold and let it run. The first hour tells you which scenario is playing out. If you're not positioned and want to enter, don't chase the gap. If gold opens at $5,560 and you weren't in at $5,250, buying at $5,560 means you're hoping for extension scenario. That's speculation, not positioning. Better to wait. If the gap fills and gold trades back to $5,400, you can enter there with better risk-reward. If the gap extends and gold goes to $5,700, you miss this move, but there will be others. Chasing gaps is how retail gets trapped. Now let me show you the gold-silver ratio dynamic. Currently at 56.35 according to latest data before markets closed. Historically, during geopolitical spikes, silver moves faster than gold in percentage terms. The ratio tends to compress. If gold moves 6%, silver often moves 8% to 10%. But here's the trap. Silver also corrects faster. If gold falls 4%, silver might fall 6%. The volatility is symmetric. You can't have the upside without accepting the downside. Let me address the regime change speculation. Some commentary suggests operations might aim for government change. From a market perspective, this creates maximum uncertainty. Regime change scenarios are unpredictable. They can resolve quickly if internal opposition is strong, or they can lead to years of instability. Markets hate uncertainty. So even if operations are successful in military terms, if they create prolonged political uncertainty, that's bearish for risk assets and bullish for safe havens. The uncertainty premium stays elevated. Here's what I'm watching hour by hour this weekend. First, official statements. What do involved parties say? Are objectives claimed as achieved? Are responses threatened? Second, oil market signals. Are facilities being threatened? Are shipping routes affected? Third, diplomatic activity. Are allies calling for restraint? Are negotiations starting? Fourth, dark market pricing updates. Are Asian dealers raising premiums further or stabilizing? Fifth, futures markets. U.S. markets are closed, but Asian futures markets can give early signals Sunday evening U.S. time. Now let me show you the technical levels that matter for Monday. Gold. The gap likely opens between $5,550 and $5,600. Resistance immediately above is $5,650, then $5,700. If gold breaks and holds above $5,700, we're in escalation scenario. Support below the gap is $5,500, then $5,450. If gold falls below $5,450 on Monday, the gap is filling, and containment scenario is likely. Silver. Gap likely opens $98 to $100. Resistance at $100 is psychological and technical. Break above $100 with volume suggests extension to $105, then $110. Support below gap is $96, then $93. Below $93, the gap fill is complete. Oil. Friday close was around $88. If oil opens above $100, that's extreme escalation signal. If it opens $92 to $95, that's moderate escalation. If it opens below $92, markets think operations don't threaten supply. Watch oil more than gold. Oil is the leading indicator. Here's the risk management framework for Monday. First, expect gaps. Don't place limit orders over the weekend expecting to get filled at specific prices. The market won't trade there. It will gap over your order. Use market orders cautiously, or wait for first hour to see where prices settle. Second, expect volatility. The first hour could see $50 swings in gold, $5 swings in silver. That's not unusual after weekend events. Don't panic on the first dip. Don't FOMO on the first spike. Third, watch correlation. If gold gaps up but equities don't gap down, that's telling you something. It means markets don't think this is major escalation. If gold gaps up and equities gap down hard, that's fear. Positioning should reflect which signal is stronger. Fourth, use stops but understand they might not protect you. If you have a stop at $5,500 on gold and the market opens at $5,560, you're filled at $5,560. The stop didn't save you, it just executed at a worse price. So stops help in normal volatility, but not in gaps. True protection comes from position sizing. If you can't afford a 6% adverse move, your position is too large. Now let me address the uncertainty around leadership and residence targeting. Reports suggest key residences were struck, but confirmed status is unclear. From a market psychology perspective, this creates a Schrodinger's cat scenario. Until confirmation, both possibilities exist, and markets will price the probability-weighted outcome. If markets assign 60% chance to leadership intact, retaliation likely, and 40% chance to leadership disrupted, quick resolution, the initial pricing will reflect that 60-40 split. As information clarifies, the probabilities shift, and prices adjust violently. Here's what concerns me about Monday. Weekend events create information vacuums. and information vacuums get filled with speculation. Social media will be full of claims, rumors, and unverified reports. Markets will react to this noise before officials confirm anything. So you'll see prices swing on rumors that turn out false. That's the danger of weekend events. By the time truth emerges, the damage to poorly positioned traders is done. Let me show you the longer-term view. Even if this specific event resolves quickly, the underlying geopolitical instability remains. This is the third major Middle East tension escalation in 6 months. That pattern suggests structural instability, not isolated incidents. And structural instability keeps safe haven premiums elevated even during calm periods. So even if gold corrects from Monday's gap, the baseline support level is higher than it was 6 months ago. The floor keeps rising. Here's the scenario I think is most likely, though I could be completely wrong. Monday opens with significant gap. Gold, $5,550 to $5,600. Silver, $98 to $100. Oil, $94 to $98. Initial volatility is extreme. First hour sees profit taking as traders who positioned Friday sell into the gap. Prices dip but don't fill the gap completely. By afternoon, if no new escalation is reported, prices stabilize 3% to 4% above Friday's close instead of 6%. So gold closes Monday around $5,450, silver around $97. That's partial gap fill. Then Tuesday through Thursday, markets await response signals. If none come, gap continues filling. If they do come, volatility resumes. But that's just one scenario. The alternative where this escalates significantly is equally plausible. And that's why position traders hold, but with tight risk management. And unpositioned traders wait for clarity rather than chase Monday's open. Here's what I'm not saying. I'm not saying buy Monday's gap. I'm not saying sell Monday's gap. I'm saying understand what gaps mean, how they behave, and position accordingly based on your risk tolerance and time horizon. If you're a long-term holder who believes in the structural precious metals thesis, Monday's gap is noise. You hold through it. If you're a trader looking for short-term profits, Monday's gap is treacherous. You could easily get whipsawed. The final thought. Weekend events create the ultimate test of preparation versus panic. The people who are prepared, who sized positions correctly, who have hedges in place, who understand gap mechanics, they navigate Monday with discipline. The people who aren't prepared, who are over-leveraged, who panic, who chase, they get destroyed. And Monday will separate those two groups clearly. I don't know what Monday brings. Nobody does. But I know the pattern. I know gap behavior. I know that first hour is critical. I know oil is the key signal. And I know that discipline matters more than conviction when information is incomplete. So whatever you do Monday, do it with a plan. Know your exits before the open. Know your maximum risk. And know that volatility creates both opportunity and danger in equal measure. If you want real-time updates as Monday unfolds, subscribe. Because the pattern is active, the gap is coming. And how you navigate it determines whether you profit or learn an expensive lesson. The people who see gaps coming position before the weekend. The people who don't are about to get educated. Which group are you in?